The Federal Reserve's beige book is showing signs of labour weakness. Meanwhile, retail sales has been jumping across the board in December. So who is correct and how many rate cuts are we going to get for 2024? Well, as it turns out, it looks like insiders might be selling the market at these highs. Today, we've got the stats on what tends to happen next. Also, can we get mean reversion with options markets starting to show flows to the negative side? We'll be going through the key levels for stocks, commodities, and cryptos in today's video. Then we have the international market. Flash crashes across the Hang Seng and Chinese markets leading into some of this kind of sell-off across the world. And the biggest indicator that we've seen in some time is starting to flash red. We're getting close to uninversion of yields. As we know, when this happens, weird things happen to the market. Let's take a look together right now. Well, welcome back everyone to the Daily Show where we talk about markets around the world. My name's Tom, and if you love markets like we do, make sure to subscribe and smash that like button. We've been running this show for over 3+ years together, and we produce daily content, including some amazing stats and macro data. Let's now take a look at what happened in the session, because 86% of stocks were down across the board, and it managed to bring the fear and greed index right back down into almost neutral territory. This also marks day 2 of heavy selling across all stocks that we've tweeted about on our X account. So make sure to follow if you're interested in checking out more about what we do there. So will mean reversion hit? Well, let's have a look at some of the charts. And I want to just take a look at this one that's been floating around the internet recently, which is insider transaction ratios. I apologize for the blurriness of the chart, but basically it's a ratio of 145. Generally over 20-1, people consider bearish. But then we go and look at the stats. What does it really tell us? Well, if we look at a week later after this report, or even if we look at a month later, it's a bit of a coin flip scenario. Now, that will play into some of the other stats that we already know are coming for January this year. But more importantly, it doesn't necessarily mean a super weak year ahead. In fact, in 92% of cases, we were up 12 months later. Now, a few people that know this stat might be saying, yes, but what about the last time it actually occurred? And that was in April of 2021 when we saw a massive read such as this, over 100. And it's the only other time in recorded history that we ever saw insiders selling at such high rates. When that occurred, markets did sell. And of course, it marked the top of the market for that period in time. So let's now talk some stats for the rest of January into Q1. I want to kind of talk about this because if you're new to the channel, you may not be aware that we've really been discussing the idea of weakness and sideways markets throughout Q1 and specifically January. You can see here after the first 5 trade days of the year were negative or very, very close together within 0.5%. We usually went into a couple of months of weakness. We also saw that index seasonality around this time of year usually does see dip dives, with generally sometimes a double dip into March, and April will be the most important month of this year. Even after 20% years, we do also tend to see selling, which you can see here. And the first 5 trade days plus Santa Claus rally led to a market that was only up 1/3 of the time in January overall. So that's a big deal. We also know that this week is January options expiration week, which brings with it its own negativity. Only 9 up and 16 down in recent recorded history. And we also know that generally the biggest amount of volatility comes in the Wednesday and Thursday. And of course, Wednesday lived up to its name this week, but we still have another big trade session ahead of us that could be quite volatile. So what are the reasons? What are the things that could worry us about this market? Well, we've been updating you on the CTA positioning, and we've already been talking about CTA positioning being incredibly extended. Yes, depending on which one, whether it's Goldman Sachs one or a few other reports, some are literally off the scale, and it shows you that they were very, very heavily overbought. Now, there's been some speculation that 4750, which is an S&P 500 level, if we got underneath that, which we did, could be a trigger point for CTAs to start reducing their positioning in a kind of, fairly large manner. Now, if that's true, and we do tend to see that, then we should be able to get through 4,700 and confirm quite a lot of technical sells, including a potential Wyckoff that we've been seeing here on the S&P 500 for quite some time. We'll go through that in the charts with the key levels coming up in today's show. But I want to talk about something that's pretty rare, and that is a very bad day for the Hang Seng and Chinese markets. Hang Seng, after a 52-week low with zero, I repeat, zero advancing stocks. Yes, it was a brutal sell-off, and this could mark capitulation incoming for these particular market indices. We'll look at it a little bit later on, but you'll notice it's coming close to its lows that we found in 2022. And 2 weeks later, only 33% of the time were markets up. Interestingly, though, 6 months later and 12 months later, the stats look a lot more favorable. Remember, Moody's downgraded China into this year. And in every other time they've done that over the last 4, I think it has been, the next year has returned positively. But that doesn't mean we're not going into capitulation yet. This is a big deal. And what a brutal sell-off that was. Another big report that we put on our X account has been that Fed swaps are starting to show that we might not be getting a rate cut in Q1. Yes, March is now easing odds down 50%. That's a pretty major shift. And it's starting to kind of point towards maybe the market being wrong about 7 rate cuts. Many central banks around the world, including the ECB, literally came out over the last 24 hours and said, well, we're going to have to do less rate cuts because you guys all expect it to happen, and it's hurting our fight on inflation. So is everything bad out there? Well, there are some good things. Here we can see easier financial conditions, and we've been talking about this for a while. In many ways, this could lead on to a little bit of a rebound in GDP growth and some strength across the board coming through. I think considering revisions to the US labor market and markets around the world, which continuously get revised down after looking like they're quite strong, that's been happening for like 6 months now, is really kind of showing us, I believe, a point where we're seeing inflection. The Fed will rate cut this year. We all are pretty sure on that one. We do know that we're getting quite a few rate cuts. We don't know exactly how many, but this is one positive sign. Easier financial conditions could alleviate some of the losses that we're going to have due to the Fed probably pushing these economies a little bit too hard in their rate hike cycle against inflation. General business conditions. Now, this is another chart that's been going around. Everyone's been talking about the weakness that we saw from the Empire State Manufacturing Index. Now, of course, this is what it shows, but the reality is that we actually could be looking at a little bit of strength. This is the expected general business conditions. So in some ways, yes, it looks bad on the surface, but it might not be as bad as everybody is considering. And that's what we're kind of getting at in Q1. We do expect pullbacks. Of course, we've been talking about it, and it would be healthy and good to see that in the market. The question really is whether this market can return like it does usually in an election year, or whether we're going into a full-blown either minor or major recession. And that's the discussion throughout Q1. We already expect volatility. It's going to be a good traders year, so definitely subscribe to the channel if you're interested in trading, investing, swing trading, all of those types of things. But we will be seeing a very volatile time here. Let's now go through what's going on with aggregate savings. This is a chart that's taken from a little while ago, but what it's again showing is that almost all the savings have been depleted, and we're back into, I guess you would say, kind of the mean of where people usually live in terms of their overall savings. It's a bit sad to see this chart in some ways, because it means many of our friends, family, hopefully not you, have lost actually a lot of their excess savings, which means investments are going to be harder and you're going to live more within the line. But that's the American consumer, and in many ways the Western consumer, where we've been spending so much money buying stuff at relatively exorbitant prices when you consider all of the sales targets being hit over the last couple of years. Also, that stupid Stanley Cup going for like $16,000 on eBay doesn't help. Who's buying that? I have no idea. In nearly 7 decades, there has never been a post-inversion equity market rally. Now, this is an interesting one. Of course, it's just one stat. This is a bit blurry here, but it's using the 10 to 1 year treasury spread, and it's kind of showing a fairly negative storyline. So basically, it's saying this rally that has been met last year in October should be getting taken out at some point throughout this year. And that could be very valid. I mean, of course, it's very possible. There are some scenarios where it gets much worse. But basically, the scenario is that whatever the rally was, it gets taken out. Then possibly we do see some recoveries. This is only one stat, though, and do remember there are quite a few out there. Let's now take a look at the options market. So we talked a lot about this options market this week. And in general, what we were seeing kind of like a 4,800 level being a huge resistance for the markets. We also saw price action hit those levels and keep selling off it. But if that had been taken, we would have been going into another squeeze scenario. Now we find ourselves underneath and around the 47.50, which you can see here based on the end of the week is actually quite an important options expiration. 4,700 also being a bit of a line in the sand. Now we are below 47.50 or around that level. We kind of know that this is triggering some trades. So we'll have to look at the price action, but it's already being led by quite a lot of weakness, including the Russell 2000. And there are many stocks starting to break through or already have broken through lows that might have a little bit more to go, which generally would mean mean reversion could be just around the corner. Let's talk about earnings because this is where the expected growth is going to be. Information technology expected to have some pretty nice growth coming into it. Healthcare also leading. We saw insiders actually buying or holding their positions in healthcare recently because, of course, healthcare has been quite heavily oversold over the last 12 months. And then we have communication services, discretionary, etc. So if you're talking about which market sectors are performing or expected to perform the best, these are the ones, with the poor energy sector getting slaughtered down the bottom. We will be talking about oil though later on because, of course, if that breaks out a key zone, we could still have a nice little shorter term trade for that particular market. Now, what about yields and financials? Do they follow each other? They are actually kind of correlated, and this is just an interesting one here. Are the lagging effects of rates on bank revenue set to intensify? I would say this is definitely a possibility. You can see here when you look through the stats of almost a decade, it's about a decade of information, it kind of does lean in. If we see yielding going up, oftentimes we will see banks perform a little bit better, yielding going down, banks kind of weakened, yielding going down, banks kind of weakened. So it is pointing towards banks being maybe a bit of a troublesome market this year, or certainly with recent market sell-offs in terms of yields, we could be seeing a bit of a sell in banks. So remember things like Goldman Sachs, they're still holding their supports. They did report pretty well, but they were also up 30+%. So whatever it was, could it be a buy the rumor, sell the fact? That seems to be going on a little bit around the markets right now. These are the earnings coming up for the rest of the week. Nothing too huge here. And do remember, these are the expected moves of the banks. We will be bringing you next week, which is going to be the big kickoff, including technology. So do remember that earnings is just about to intensify and there's a lot more on the horizon. Now let's move over to unusual trading activity because, of course, we did see some really big trades on the Russell coming through and they've eventuated into a pretty nice trade. Now let's move over to the Russell Top 200 Growth ETF. We just saw a big transaction come through. Is it a buy or is it a sell? Well, yeah, you would think it could be, of course, a sell across the board because most things have been sells recently, though this has been one of the strongest sections of the Russell, of course, being the growth section. You can also see here S&P 500 value fund, like the S&P that we put in the previous video, large transactions coming through. Again, could be consistent with the sell. And I just want to remind everybody, this was the Russell from the last 24 hours where we saw a spike up and it touched into that supply zone. So this is basically where we see the mixture of normal technical analysis being supply and also seeing the huge trade volume. It's nice to have both together, isn't it? Because it gives you a little bit more, validity to this particular trade. And when we see that big wick rejection coming off it, we can tell the market's pretty excited about that short, and they certainly pushed it over the last 24 hours. Let's now move over to the markets, and there were big volumes. Look at this, huge volumes coming through on the options market. 47 million versus 39.5 normal. And for the first day in, I would almost say like 3 months, we're seeing a fairly strong put buy. So 54% puts, 46% calls, 21% retail trades, and small traders made up 13%, which is a little bit up, I think, on the normal day. And then we saw all this unusual activity. Now, there were heaps of unusual trades. There was PayPal actually doing better than normal, 2.46 with a lot of calls coming in. Then we saw Tesla getting huge put volumes on it at 1.46 versus the 990 calls, obviously down 2%. We'll look at that stock later on in today's video. And we just saw, in general, a elevated amount of trades coming through pretty much everything, including all the major indices. Now, there were a little bit more puts coming through on the major indices, but you would have to expect that. It was a down day, and 86% plus 86% down declines. That's going to get people excited into the short. Were there any sectors that were up? The answer was no, not in the majors. You can see here everything was down, and it was led also by basically gold, solar, and we also saw some REITs as well coming through with sells. Now, the defensives were doing better, XLP, XLV, and financials, because the earnings so far has been okay, only down a little. So overall, it was just a big sell across the board, taking us to a 5-day total of almost every single sector now being down, including some brutal sells through gold and solar and clean energy. Now let's move over to the charts. First up, central bank liquidity. What's going on there? Stability, I would say, from the last 24 hours. No real signs here, but there are plenty of lead indicators that have been weakening now for a couple of weeks. First up, let's have a look at the percentage of stocks above everything. That's above 200. There are, of course, mostly the stocks are still holding above the 200. This is above the 50. Surprisingly, it actually bounced a little bit near the end due to some buying coming through. And we actually saw a ding here for percentage of stocks above the 20. That dropped to 25. Now, some dip buyers like to buy this type of area. And that's because what they're doing is they're saying, okay, well, the percentage of stocks has dropped to kind of like a more extreme level on the shorter time frame. That is taking us down to 25. And you'll notice in history, this is an interesting level for markets. Is it the bottom? Not generally, but it is a point where you can overlay the S&P and have a look at it. So percentage of stocks above the 20 moving average, certainly moving down to a pretty extreme low. Well, not extreme, but definitely a low scale. Let's now move over to some yields. Why did we fall? Well, in simple terms, yields ended up spiking up, and this is not good for the market. And obviously the market doesn't like this because it means it's starting to take out some of those 7 rate cuts and saying, well, maybe we're not getting as many as we thought. In many ways, I think this is mean reversion. We've been talking about it now for a couple of weeks, and it's been pretty much one of the main narratives we've been talking about on this channel, and it's happening. And been pretty nice. So 4.2% is certainly a level we're looking for. That's around that 20 moving average, which you can see here on the weekly. And it seems to be intact in terms of there could be more to come. At least that's the suggestion from this chart. Pullbacks to be met by bull demand, you would think, on yields. That's meant the treasuries are coming down. Again, we use some big transactions in here to kind of help us with that type of statement. And we can see that markets have been coming down in treasuries. And that's, again, just mean reverting. What about bonds? Well, bonds actually held pretty well through the session. This is one of our indicators. And it's showing you that maybe there's some stabilization around this level. But if this comes back down to red in the next session, then we are probably moving further and lower. That's a fairly nice stabilization though, but it's only one trade day and it's not enough with bonds. But we did see that island reversal, remember, which is a gap up and a gap down. So further weakness could be on the horizon. This is another worrying sign, which is the Dow Jones Transportation Average Index. Now, we don't want to see this weakening. We obviously did here, which was a big deal. Now, if you want the date on that, that was the 3rd of January, which is pretty much where all of this kind of stuff started to begin. And depending on how this closes, there's going to be some significance here because we're starting to see significant shifts in a couple of these leads. You'll notice here mean reversion getting hit, obviously a key level of demand for the transportation average. If this gets taken out, we could be seeing weakness on the charts that many traders won't want to see. This is something that turned the markets back in October. If this starts to weaken and getting through its 20, we could be going back down into 14,400 or even 13,600. And if that happens, well, the market's most likely not only just going to mean reversion, but it could get even a little bit worse. Home builders also showing signs of turn. To me, this is an area where we're getting an island reversal where weakness should come in. And it's, again, not looking fantastic. Even though the trend has been up, this is the first sign of weakness that we've seen in quite some time. So again, we reported on this and we talked about it together. Now let's move over to the US dollar. So often when we've seen the US dollar up, we've seen stock markets fall off. It's basically a risk off kind of concept. And this was a big turn. So we got a big turn at the start of this week and now we're rallying up. And we're kind of looking for a 103.80 to 104. Is the end happening yet for the dollar? I would say no. I think the dollar's got a little bit more in it. What do you think though in the comments down below? At this stage, it looks like pullbacks could be met by bull demand. And you'll look on the weekly that we did just hit the mean reversion. So some people could argue that's a pretty key point. I'd like to see it go a little bit higher though first, and of course push that market down as well. That would be quite good. We also moved through some of the significant kind of traps here a few days ago, which was to get above that 20 moving average. So really to show you that the start of a turn could be here, but 103.80, 104 big level. Let's now move over to gold. So gold slapped into our 2003 area. It found a little buyer here. We've obviously been talking about this zone for a while. It was our expectation that gold could get down here, and how it forms structure here will be very important. Now, am I a bull for gold for a little while? I will be, but as we've talked about, once we saw this, it was a bit of a sad day for gold bulls because we were looking for even more. But when we saw that, we knew we were going into sideways action for a while. We have been. It's been up, down, and all around. But 2003, an interesting hit. Day traders will want to be looking at the small timeframes here on gold to see whether there's some buy signals. Now let's move over to oil. So oil has been up, down, and all around. 70.50 got defended again. Nice. That's pretty good. This is obviously our defense zone for oil. And we're looking for a 74 plus break daily. So we haven't got that yet, but we do know that options are all over this thing on the call side. So there have been some different people talking about different strategies. Probably one of the best strategies has been selling puts recently on it, if you know what you're doing. But that's maybe about to change because, of course, 74 plus is going to be a very big level and could create a 78 squeeze and even an 82 to 84 kind of a barrel narrative. Now, everyone kind of thinks, oh, well, that makes sense because of the Red Sea stuff and everything that's going on. But just remember, everybody was bullish here. Price action is ultimately your win because over here, we were talking negative on it. Then we were talking positive on it. And now, yes, it makes sense. But remember, sometimes it does need to go with the narrative. And that's because we want the narrative to hold up over time. Don't ever feel that the narrative is the real reason, though. What tends to happen is markets will move from equilibrium to equilibrium point. And that's exactly what could be happening on oil very, very soon. Now, let's take a look at Tesla. So Tesla sold again. We kind of suspected this would occur. And the reason why we suspected it would occur is because that tends to be the way that the market trends. There was nothing really holding it up in the previous session, and we sold kind of aggressively down too. Now, we're off 7 days in terms of earnings result for Tesla, but it could be a bad year for it. A lot of analysts are downgrading it across the board. We don't really care too much about that, generally speaking. We're just looking for price action, but 210 hasn't been hit yet. Maybe in pre it was hit. And we don't really have a super amount of structure. Now, we do have a gap down, obviously a bit of a hold here. So I guess if the markets did rally and you got a gap up, you could class it as a little bit of a day island reversal and then look for maybe a movement towards the 20 moving average, which you can see here is being held on the 2 hour. So that might be something on the cards, but yeah, a little bit of speculation. You probably need a stronger system for it. Nvidia did well. To hold up in a day that was sold off is pretty strong. And you can see here, Nvidia is still on its way to 600. At least that's what it's trying to do. And it's really the most bullish stock on the market at this stage. If you take a look at the SOX, which is one of the semiconductor ETFs, you can see here as well, it's trying to hold itself. So 550, certainly underneath that, I would be setting an alert. And the reason why is because if this bullish hammer that just happened gets taken out, that's taking the strongest market sector and weakening it. If that happens, well, it could get pretty brutal on the market. So certainly one we're going to set, and I'll do it right now together. There we go. We've got an alert just underneath there. Now let's move over to the major indices, and we'll start here with the Hang Seng because the Hang Seng got destroyed. It got destroyed, and I would say we're in capitulation mode now. Now, where's the bottom? I don't know. Could it be this low? It's possible. It could go into a flash crash. This is the type of thing that's a little bit worrying. I could see it easily taking out 14,927. And at this point, we're looking for the weakness to be met by some serious buying. This is basically now entering into capitulation. And capitulation is its own type of trading strategy, which takes people that really need to know what they're doing in the market and really manage their risk. So it's a big sell, and it's going to happen across the board. I would say it actually will mark the low for the year. It might be a big call, but it certainly could mark the low for the year for this particular market when it eventually occurs. Because as we saw before, the stats say that over the next coming weeks, we do get some brutalization. It could get much worse. Sometimes it doesn't, but generally it does. And then we often see the low being put in as it wipes so many people across the board. It could get way worse though before it gets better. We'll keep watching that one and we'll put it on the daily show. Let's now move over to the German market. It fell off. It ended up closing at this little doji here, which is 16,400. It's a partial support for the DAX, but really the main one's down at 16K itself. I could see something like this occurring. Even just a further sell to a new low is probably going to create flash across the board. I'm going to set an alert for a new low because this could be a huge deal for generally just the markets across the world, and German DAX looking kind of weak. Aussie market now, does it look bad? No, it just looks like it's pulling back. I mean, it hit the high. I still think we'll get through 7,600 plus in the future. Obviously a momentum play up here. But pullbacks on the horizon, nothing really holding it up. It's just about the US market. And speaking of the US market, another pretty nasty sell on the Russell 2K. So the Russell 2K, I don't think it's stopped at a level that's really going to hold it, but you'll notice that all these market indices have slight buys into the back of the session. And that's because there is still a very strong buy the dip style scenario that's been going on. And that's because everybody's been doing it for quite some time. We've got accustomed to a buy the dip. Do I think we should get down to at least the most traded level? Generally speaking, yes. That would be about 1860 for this market. The NASDAQ itself, you can see again, weakens, comes down to our watch reaction level, which turns out to be also the daily 20, and then it strengthens back up. So there's a lot of market action where we're seeing weakness come through, but then instantly that it's getting bought up by the dippers. So you can clearly see BTD is still going on, but certainly 86% of stocks down for 2 days is not really a positive signal, I would say. It's usually pretty weak. Let's now move over to the S&P. Now, if we look at the real S&P, this SPX, we can see here a gap down, couple of days now holding. So we've got a couple of days now holding. Could we get a gap up? If we do, is that actually an island reversal? Yes, it would usually be one. So bulls will be looking for a gap up here and getting kind of excited about it. I think that it's only 1 day, by the way, down. Sorry about that, guys. It was 2 hours chart I was on. I was looking at too many candles. But yeah, a gap up could be an interesting one. I would think that if we get underneath 4,715 or 14 again, this could really weaken off the market. And the reason I want to bring up the SPX and then we'll go to the futures is because what you'll see here is we have 3 higher highs. Now, this often looks like a Wyckoff distribution, and early signs would be saying that's what we're seeing. We could have the BC, we could have the UT, and this could be a UTAD. Now, I don't really care about labeling them so much, but I do like to see a little bit of higher highs that keeps getting hit down. And you'll also notice that markets, while they were kept buying the dip, there's a buy the dip, a buy the dip, buy the dip, obviously creating some dojis and big wicks. That now got closed underneath, whether you like to admit it or not. Is the 20 moving average still holding up? The answer is yes, it is. Will a close under this be significant? I would say yes, it will be. And also 47.50 being closed below is, I think, a fairly big deal for the options market. Let's now take a look at the futures, which looks a little bit more convincing. Again, we have the triple high happening here, 4,800 stopping it. Big rejection week here. Again, rallies being rejected fairly quickly. So showing that someone is trying to sell each time, getting out, maybe a bit of exit liquidity. We get a close underneath, or at least a market that moves underneath 47.37, which could be quite significant and show that rallies at this stage should be met by sell demand. And then if we get under 4,700, we've already speculated that opens the floodgates to that big 46, 45, 50 zone and mean reversion. We've got a lot going on down here. We have almost nothing going on in between here. And of course, we have some strength at 4,700 to 47.20 just based on options alone. At this stage, the price action would be still pretty much going with the negative side. Now let's move over to options and not options. Let's move over to Bitcoin, have a look at the crypto. And crypto is just floating around. So somebody's trying to probably buy the dip here. You can see the structure is relatively sideways. So if we get underneath 40,500, is that going to be big? I would say yes, and it could create a flash crash on crypto. So So just remember, Bitcoin has changed trend on the small time frames. It hasn't on the swing time frames. But if it does and it gets underneath this level and doesn't instantly wick back up against it, we're probably moving down to the 36s and maybe even under 30. Now, would I be concerned as a Bitcoin or crypto hodler this year? Probably not, because we do know we're in the halving cycle and it's fairly normal for markets to pull back into that. So this Q1, what's going on? Well, it's expected to be volatile. We've got stats kind of pointing towards that. And of course, we also have a whole bunch of very worrying signs from the recession side as well. So there's going to be a lot of concern in Q1. April will be one to watch. There's going to be a great trading, swing trading, and even investing year. So make sure to stick around for the channel if you're interested and subscribe. In terms of major news for the rest of the week, we don't really have too much except for the prelim UOM consumer sentiment. So do remember, Thursday can be a pretty volatile day. Generally, the options expiration itself is a little bit weaker and doesn't necessarily have as much movement. We did expect this week to be red. We know where the big levels are, and we've already crossed one of them. So it could be time for the bears to really start to try to commit to this trade. Again, remain flexible, guys. If 4,800 is taken, sometimes that is trading. And if that occurs, then we're going into a squeeze. But all signs at the moment are quite negative. At least enough of them are edged into that point. Mean reversion, maybe here we come. Thank you very much, and we'll see you in the next video. Bye for now.